Hello, people. I want to reinforce the rules of debit and credit. What we have in front of us is actually a solved problem, except for the account balances. But I thought I would bring it up here to reinforce your recording rules, debit and credit-wise. Whether you're in a journal or whether you're in T accounts, you would have to read a transaction and analyze what has happened, and then determine which accounts are affected by the transaction, and then knowing that there must be at least two accounts, and that there has to be a debit and credit equality recorded in the accounts. So I would look at this and say that in transaction A, the owner invested $9,000 cash. So the left side is always the debit side. The right side is always the credit side. It doesn't matter what kind of an account it is. Left and right mean debit and credit respectively. So again, analyze. The owner invests $9,000. So what you would tell yourself is cash is an asset. It's going up. How do you add to an asset? By a debit of $9,000. Other side of that transaction would be to go on the other side of the equation and balance it off with a credit of $9,000 to the capital account. So the transaction analysis would be add to the asset with a debit, add to the capital with a credit. You've got debit and credit equality. You got one account, the asset account, going up. You got the capital account going up. Debit the asset, as you would all assets. The debit side of an asset account adds to the asset account. Okay, so that would be transaction A, and I would look at transaction B if it was presented to me, but I'm going to tell you the performance of services occurred, but I and the customer agreed to get paid later, which means the customer owes me $7,000, which is added to accounts receivable, which is an asset. It is something that is of value to me because I have a right to collect that. So it's not a cash revenue, but yet it's a revenue on credit. So I debit the accounts receivable account and credit the revenue account. We always add to revenues with credits. They're a form of capital account. If you can remember in Chapter 1, if you had a revenue, you would add it directly to capital. But now that we're using a debit and credit format, we have to implement the use of debits and credits in order to achieve the additions and or subtractions to the accounts. So here we are earning a revenue on credit, debiting to add to the asset. All assets are always debited to add and credited to reduce. All liabilities are credited to add and debited to reduce. The capital account is always credited to add, and if it has to be debited to reduce it, the debit will go there. The withdrawals account, instead of debiting the capital as we did in Chapter 1, we debit the withdrawals account. Whether we do it here or in the journal, we'll write out a $320 debit. We'd write out a $300 debit if it were in the journal. We'd write out a $600 debit. Now, let me just pick up again so that the earnings of $7,000 goes into the fees account. Then in transaction C, it appears as though that I purchased a $2,300 piece of office equipment. What kind of an account is it? It's an asset. How do you add to assets? You debit them. So you've got a piece of equipment coming into the business, adding to your total assets. How do you add to the asset? With a debit. Now, how did you pay for it? Did you pay cash or did you pay, will you pay on credit? And what I'm seeing here is that it is a credit purchase. So note that both sides of the equation here are going up. We're getting $2,300 in assets, but the creditor has to be paid, so that we owe and have incurred a liability, and in order to add to the liability, we have to credit that account. You've just got to commit these debit credit rules to memory, and know that for every transaction, at least one debit and one credit occurs, at least two accounts are affected, and the recording of debits and credits must be equal. 23 debit, 23 credit. And you'll see it with every transaction. Okay? So that if I took that 23, again, you see it as the debit, add to an asset, add to a liability. Liabilities are increased with credits, decreased with debits. So if that was transaction C, I'd quickly go to D, which I'm chasing here. I see that we paid something here for $800. So you're looking at account and you see an $800 credit, a $300 credit, a $6, and so on. You know you've made cash payments because each amount is entered on the right side or the credit side of the cash account. So that's the addition side, that's the subtraction side. Case is with all assets. Now that $1,000 that you see there, reduced accounts payable. Apparently the person that owed you the money paid you part of that $7,000. And how did you record it? You came up here and debited cash for $1,000. You could have written it out in a journal and then come back and posted it in a ledger. So Chapter 2 and Chapter 3 are the same, except we use T accounts for teaching. In the Chapter 3, we use formal journals, where we write out the name of the account and to be debited, and we enter the debit and we enter the credit accordingly. So there's really no difference technically, except that the Chapter 3 is realistic in terms of how the entries are prepared in practice or inside of an accounting system. Okay, so that we collected cash for $1,000 from our customer. We reduce, and you're going to see how the balance will get reduced by that $1,000. Getting back to that $800 that I paid over here, I can see that that payment was for, okay, we're paying off on account. So I owed 23, and if you saw the narrative or saw the bill, and you got the approval to pay $800 off of that creditor's account, you would debit to reduce a liability, add side, subtract side. So that, you know, when you're on the left side with the assets, the rules, the debit and credit means plus and minus. When you're in the liability accounts, the opposite is true. Credit to add, debit to reduce. So that applies to assets, liabilities, and capital. Okay, assets, liabilities, and capital. Those are your three equation accounts. Debit the left to add, credit the right to add, to balance. If you got to reduce both sides, you debit one side and credit the other. That reduces accounts payable, that reduces cash. Okay, which is an asset. And you got to ask yourself, what accounts are affected? There has to be two. What happened? I paid off $800 of the 23. Okay, so how do we do that? By debiting to reduce the account payable and crediting to reduce the asset. Debit to reduce liability, credit to reduce asset. Okay, so then I see here, what was this payment for? Obviously, it's a cash payment of $300. So I'm seeing down here, we debited utilities expense. Now we're adding, every time we debit an expense account, we're adding to the expense. so that when we do our trial balance, we'll add up all the debits to each of the expense accounts, and then, in other words, if there was another utility bill for $300, then the balance would be $600. So that you have to, in chapter 1, you think that an expense is a decrease to capital. Well, it is, but instead of debiting capital, you debit and accumulate. You accumulate the negative items. The same thing with the withdrawals. You accumulate the negative items. Okay, so I think that you got the drift here, hopefully. Again, that 320, instead of debiting the capital that we did in chapter 1, we're going to come down and add to the amount of withdrawals. And I say add to the amount of withdrawals because later on when we close the books, we're going to use that as a negative. Then we're going to debit the capital account, which reduces the capital account. Okay, but in the meantime, we debit, instead of debiting capital, we debit the withdrawals account. The same is true with expenses, expense accounts, withdrawal accounts. Their debits are made into their own accounts instead of directly reducing the capital account. Instead of adding to the capital for revenue, we credit the revenue accounts themselves. Again, the revenues, the expenses, and the withdrawals are known as temporary capital accounts. So instead of adding now to capital, we add later. And then we close out the revenues and the expenses in order to start another accounting period, and then add the positive effects of revenue, the negative effects of expenses, and the negative effect of the withdrawals. We update the capital account. Okay, and then we start a new ball game. Clear the scoreboard. Start a new game. I don't think I missed anything. What's this F guy here? $600. What did I do with that? Oh, okay, here, that's just the payment of rent. Same old, same old. What accounts? Rent expense. What's happening to rent? It's going up. How do you add to an expense? You debit it. The other account is you're writing a check. You're paying cash. The cash is being reduced. How do you reduce cash? With a credit. So you pop your credit in there. Okay, kids? So now I'm not going to do the addition. When you're using T accounts like this, you have to add the debits and credits up. Those are the account footings. And obviously, if there are more debits than there are credits, here, let me just show you the pop. Okay? So all they did here, guys, is we went through all of those transactions. So they're just simply showing you that your cash account has a $14,000 debit. Again, a $14,000 amount of debits and $2,000 in total credits to the account. So the difference between the debits and the credits equals what they call, of course, the balance of the account. So if there are more debits than credits, the account is said to have a debit balance. That would be what they also call a normal balance, and that's the positive side of the account. As you can see, the positive side of all the assets is a debit. We had 16. There was a $1,000 cash receipt, reducing that 16 to 15. We had 2 debits to add to equipment, so the balance of that account is 15. Okay, we had a credit of 12 and a debit of 3, bringing the balance to 900. We had a single credit, a single debits, a single credit, a single debit, so that those balances represent the single entry that was made in those accounts. So that when after the account balances are all determined, we then go ahead and prepare a trial balance. Okay, so it simply means we list the accounts in the ledger order, which would be the assets first, the liabilities second, the capital third, the revenue accounts fourth, the capital followed by the withdrawal. So it would be the capital, then the withdrawals, then the revenue, then the expenses, and we prove the equality of debits and credits. So you can see all I'm doing here is taking the account balances, 12, 15, and 1,500. 12, 15,000, 1,500. Accounts payable, credit. 900 capital credit 13. There they are, 913. The $1,000 balance in the withdrawals account. Copy and paste the fees account. Right? Credit balance. All right. Copy credit, paste credit. Copy the debit, paste the credit. So the debit rather. So again, we prove equality of debits and credits, and when we're done at the end of the month, of course, the purpose of the trial balance is simply to prove that you haven't thrown off debit and credit equality. And then if we took this further, which we're not, but we could prepare our financial statements from this trial balance. If we had to prepare a balance sheet, well, what would we do? We'd take all of the assets, total up the assets, we'd take the liabilities, total those all up. We'd have to adjust the capital, of course. Okay. We'd do an income statement first, wouldn't we, for the statements, right? We'd do what? We'd take the fees earned, revenue, minus the two expenses. I can see right there the net income is what? 16 minus 4 or 15.6. Easy. Then we'd prepare an equity statement, 13. Plus that, what did I say, 15.6 would be the net income, and subtract the withdrawals, and you'd have your ending capital balance. Then you go ahead and do the balance sheet. You'd have asset, 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 liability, and then you'd have your ending capital account from the owner's equity statement that you just prepared. Okay, so use this, go over it. I know that, there could be, you got to reinforce these rules of debit and credit, period. There's just no two ways. Whether you're recording transactions in a journal or whether you're doing them in T accounts. Of course, the journal and the formal ledger is the way it's done in practice, but you should be able to learn using T accounts. When I do lectures in front of a class, on the whiteboard, I create these and build them step by step. And you got to study this stuff, kids. You got to pound it in. You got to pound it in and essentially memorize it, and then you'll get a better understanding, the reinforcement. There's so many videos that I created. There's so many resources that are inside of the multimedia library inside of my accounting lab. Okay, you can't just look at this stuff once, and if you can and get it once, that's fantastic. But it takes the average person a few times, a few go-arounds to get this cemented into the middle of your brain. So go for it and just use this. Use the resources. I hope there's a bunch of videos inside Blackboard. Module 2, I went over that for you. Click on Module 2, you'll see video, 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 video. Go to your multimedia library. There's 3 or 4 more videos there on debits and credits. Okay, so you should have plenty of resources. Your PowerPoint slides inside the multimedia library. So you got a ton of resource material. So again, I urge you to go over it and over it and over it, and you got a lot of homework to practice this stuff. Okay, good luck. Don't forget your work is done. Is expected. You look at your calendar and you'll see the due dates for your quizzes and your homework and then your Module 2 exam. Okay.